All right, this is being recorded. One thing I have to say at the beginning of all these webinars, watch this webinar again after you've seen it one time. Even if you're watching it on recording, try and watch it again. First time through, try and absorb as much as you can. The second time through, it'll sink that into your longer term memory, all right? If you just watch it once, you're going to think, I got this. And then a week, 2 weeks down the way, you're going to be going, what were a couple of those rules? So make sure you watch it again. Take the notes maybe the second time through. Try and absorb as much as you can the first time through. And this is going to be on low volatility strategies. We're going to continue to increase the volatility coefficient, if you will, as we go throughout all of these. But right now, low volatility strategies, we did the long call, the long put. Now we're going to do long call spreads and long put spreads. And I set these up, generally speaking, a little bit different. And there's two ways to set these up, and we'll talk about the two different ways to set up a long call spread. And they both have their own little rules. JQ, thanks to me. I appreciate that. Good to have you in the house. Herman, good to see you. It's from Georgia, Stone Mountain. All right, cool. So let's move on. I got to get a couple of things out of the way real quick. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or Wall Street Journal for commentary on everything from economic to geopolitical and market analysis. I started trading in college with a psychology degree, self-taught in a sense for part of it. Decided to switch over to finance and then graduated with a finance degree, moved up to Chicago and started working on the floor as a runner. Sold all my stocks and bought myself the cheapest badge I could afford, and have been continuing to trade my own money ever since. So in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products, just about all market conditions. 87, I was not there. Just afterwards. Anyway, any opinions, news, research, or analysis, or other information contained in this webinar is to be provided as general commentary and does not constitute investment advice, you guys. We're here to teach you guys these strategies, not to just give you like different trade opportunities. I mean, I will go over different trade opportunities I see, but the reason why I can't make that a recommendation is because I don't know if it fits in your portfolio. I don't know what your directional assumption is. I don't even know what your risk parameters are. So all of those things taking into account, there's no way I could possibly give you a specific stock and a specific strategy to implement in your portfolio. Take into account your own situation and do your own homework. Past performance of any trading system or methodology is not necessarily indicative of future results. All right, you guys can follow me on Twitter at Wolfman's blog or our parent company at ProTraderStrat for all kinds of market wisdom, hopefully. All right. If you guys watch the 101, this is, or the calls and puts, this is just a little bit of a refresher. This is for some of the people that didn't get it. But some of the major options 101s that we really need to go over and make sure we are well aware of is delta. And delta affects an options premium in relation to the underlying for the first dollar move. Now, this is going to be pretty easy to come up with for, if I can had my platform come up on the right side. All right, so one of the things we're talking about here is delta, and I have the Greeks right over here, delta, gamma, theta, vega. And if we go down here, probably don't need all of these. Let's just go to 14 or something. So we're looking at the delta here, and see this delta for this 80 strike is 49. So what we're saying here is that when this underlying trades QQQ from 185, what is that? 185.83 and moves up $1. So it goes to 186.83. That means that this particular strike will increase on the first dollar by 49 cents. So this premium will go from $2.38, and you add in 50 cents, so you're going to get $2.80. What is that? 86 cents, 87 cents. $2.87. Okay, so that first dollar increase, the underlying gains $1 for that first whole dollar, but this premium is only going to collect an extra 59 cents. Similarly, this 86 1.5 strike is going to increase by 46 cents. This premium is going to increase by 43 cents on that first $1 move, okay? That's what delta tells us. It tells us a lot of different things as well, probabilities and things of that nature that I go over. But this is telling us what that $1 move will increase the premium. That delta will also tell you the probability of finishing 1 penny in the money. So in that last example, on that 85 strike, what we were showing is that the 185 strike here, that there's a 49% probability this underlying will finish in the money at expiration in 22 days at 186.01. That's the probability, a 49% probability that this underlying in 22 days will finish at 186.01, okay? 2 times this delta is the probability of being kissed during the duration. So in the next 2 days, it could go up there, and that would make those probabilities. So about a 98% probability that at some point during the duration of this underlying contract, option contract, it will come up and kiss that, okay? Are you going to talk about call spreads? I am, Trevor. We're going to talk about call spreads today. But I want to go make sure everybody's clear on these Greeks real quick. And then gamma is the rate of change to delta. So think of delta as data, because there's so many things that delta can tell us. Probabilities of finishing in the money, probabilities of being touched, the change in the premium. Gamma tells us what the change is to delta. So gamma goes back to delta. It's the gain on delta. All right. So the second dollar move, we talked about this being the first dollar move. So when it goes from 186.83 to, from 185.83 to 186.83, delta adds in. Okay. On the second dollar move, so now we've gone to 187.83. How much does this premium increase? Well, the first dollar got the 49 cents. The second dollar gets this gamma added into it. So it adds in 55 cents on the second dollar move. All right. So that first dollar move, we had 187, right? So 187 on the first dollar move. Now we add another 55 cents in there, and we get, testing me here, 148. Is that right? That's literally pulling it out of my hat. So what do we come up with? $2.87, and then you add in plus 55 cents for the second dollar move. The 55 cents gives us, it was $2.87 plus that 55 cents, because that's the delta 49 plus the gamma of 6 cents, right? So we're talking the second dollar move. That means that premium, all right, Eric, $2.87 plus. So the hard thing about this is when you're talking and trying to think, it makes it very difficult. So the first dollar move we discussed, it went from 230, or we could even say 240, add in the 49 cents. So now we're at 289 for a perfect example. So 289. So 289. Now on that second dollar move, we take the delta plus the gamma, and we've got an extra 55 cents. So the second dollar move, we would assume, Eric, get it together, please. 289 plus 55 cents. Second dollar move, we would expect our premium to increase to $3.44. Did I lose anybody on that with my calculation? So the first dollar move, we go from $3.40, add in the first 49 cents. That's delta. Then on the second dollar move, we've gotten to $3.40 plus that 49 cents, 389 plus the 55 cents gets us to 344. So on the second dollar move, all right? So gamma goes to delta. All right, it adds in on only the second dollar move. All right, and yes, on the $1.25, you're going to get maybe an extra penny on that gamma. Okay, does that make sense? So as you're peeling through that. All right. And theta is the thief in the night. Theta is the thief that comes and steals your premiums. It's the impact of time on premium. And the closer to expiration we get, that's going to start ramping up. But this theta, what it tells us is that every day that goes by, these premiums are going to decrease by this much. So tomorrow, this premium will decrease, all other things being equal. Everything else, nothing. The market didn't change 1 penny. Volatility didn't change 1 penny. Just the one day goes by, this premium will decrease by the theta, the thief. That's how much he steals every single day. Now, the further out in time you go, you can see that theta coefficient drops precipitously by at least a penny a day. And in some cases, you know, the further out you go, it's going to be even less. All right. So it's going to decay slower. All right. So think about this in relation to what we are doing. We are buying premiums. We're buying a spread. So when we're buying that, we do need to worry about theta a little bit here because it is going to tick away at our premium. We want to have that be as small an incremental value as we can. So going out further on the option chains, expiration cycle, 22 days to 55 days. So Nov and D. So I want to kind of be outside of 45 days to set this up is what I really like to be. 45 to 65 days. We don't quite have that. So I'd probably, depending on how quick I thought this was going to happen, do the Nov or the D. Usually I'm going to show you, I will go to the December and I'll show you the reasons why when we start really getting into the details here. All right. So theta ticks away. And then volatility is the measure, or vega is the change of volatility. So volatility is vega. All right. The VV, vega. Vega impacts our premiums. So when we're buying this, we really would rather have our volatility start to expand, right? Because as volatility expands by 1 percentage point, if volatility in this underlying expands from 1565 to 1665, 1 percentage point increase, this premium is going to increase by the vega. All right. So it's going to go from 243 to 263. All right. For the bid. Same thing out here. The further out you go in time, volatility affects those premiums more. So we talked about this. We want to limit we want to limit theta, but we want to exploit vega because if we're buying something, we want that volatility to add into our premium, right? So if we want volatility to add into our premium, what do we need to do? We need to have volatility go up. And the only real way to really figure out when volatility is going up, and it's not a perfect scenario, but what we do is we look when volatility is really low, the probabilities our volatility is going to increase, right? Just as if volatility is really high, we would expect it to decrease and come back to the median, right around where the middle of the road is, okay? So we would expect volatility in the Qs to start creeping up because it is so low. What is low? Low is below 50, high is above 50. And I'll get into more detail about that as well here. Once we get started, now that I've got the 101 stuff out of the way, let's get on to the call spreads. All right, so this is the long call spread. And what we're going to do, generally speaking, is I like to go for the in the money call and then short the out of the money call. And I'm going to tell you how to set that up. If we buy the in the money call, we're looking for an 84 delta. All right. The in the money call should be about an 84 delta. And the short call, the short out of the money, is going to be somewhere around a 16 delta. So we've talked about standard deviations, and I'll talk about them a little bit more. But in a sense, what we're doing is we're buying the one standard deviation in the money call and selling the one standard deviation out of the money call. When you do this, have you guys ever heard of a collar? A collar is a strategy where you have the underlying stock. You own the underlying stock. And Mark Cuban was famous for doing this with Yahoo. He got a bunch of Yahoo stock when he sold that crummy radio station to Yahoo. but he wasn't allowed to sell it for so long, but he wanted to protect it because it was at almost all-time highs. I think it was trading around 250 at the time. So he started buying puts and then selling calls because he wanted to protect himself. He wanted to limit it as upside. He wanted to have it called away if it went too high. And he wanted to protect himself to the downside by buying puts. That's creating a collar. When you're doing this long call spread, the way I'm talking about doing it, we're buying a further duration option contract and we're buying an 84 delta. So our risk is limited below that strike. So that's where that synthetic put comes in. It's since we're limited to the downside in this collar strategy, the stock goes down below the puts, then you're out of it. In a sense, when the market goes down below our 84 strike, we're out of it. It's the same thing. That strike has an embedded put, synthetic embedded put in there kind of. And then on the short call spread, on the short side of the call, then we're limiting the upside. The beauty in when we do this in the money and the out of the money is we've gotten rid of Theta in a sense, and we're limiting Vega as well. But what we've done is this strike that we buy is going to be the value of that underlying. Okay, so strikes, underlyings, options have intrinsic and extrinsic value. Intrinsic value is what it's worth. So all these options out of the money have really no value except for extrinsic value, all right, which is like theta decay, okay? That's theta in there, and volatility is added in there as well. But those things will come out. When we buy this 84 strike, let's just look at a better example. Well, when we're buying this 84 strike, I want to find something that I don't have 1,000 different things in. So I'm just going to go with applied material. I have positions in this. I'm going to be talking about stocks, you guys, that I have positions in. Please know that I'm not trying to get you guys lemming off the cliff. It's just things that I've seen. I'm going to talk about things that I know, right? So with applied material, somebody's asking a question here. The short out of the money could be assigned. Well, if you get assigned on that out of the money, remember, you have the in the money option also that you can assign somebody else on. So really it is a, you don't have that risk of being shorted. You can just assign it, offset it, okay? Because you're long the calls, short the calls, short calls get assigned, then you are fine because you have the long calls that you can assign or you can call away from somebody else. Okay. So, and it's going to be equal. The other thing is, Marcel, is with my rules, this out of the money call isn't going to be a problem for very long because we're going to have reached our profit potential by that time. All right. So we're not necessarily going to have to worry about that so much. Okay, and I'll explain that a little bit more as we go along. So what I was saying was if we buy this call, because we have the right but not the obligation to take this long stock, if the underlying goes below us, we can just do nothing, right? So that's where that synthetic put is. We have no risk below 35 there, all right? And then what Marcel was talking about, these calls that we get short, because we're kind of looking for maybe the 20 calls because that's closest about the delta we're looking for. We wouldn't have to worry about that because our profit potential is going to be met. Now, I've talked about this. We're going to go further out in time, and I'll get into that a little bit more. But let me get through these rules real quick before I get too much into the weeds. But that's the idea. The other thing is, if this doesn't work out with my rules, the in the money, because I have specific collection of premium you need for the width of the strike, which is 50% the width. We need to pay it's a gray area, but we're shooting for 50% the width. For instance, if this in the money to the out of the money was $5 wide, we would not want to be paying more than $2.50, okay? If you're going to the out the money call, which is maybe right there at the money, slightly out of the money, slightly in the money, either way, those are the ones that are right there at the money is the way I look at those. To the out of the money, then we want to pay no more than a third the width of the strikes. Okay, so on a dollar wide, 33 cents. All right. So if we did the at the money and a dollar wide, we'd only want to pay 33 cents. If it was $5 wide, then we wouldn't want to pay more than like $1.50, $1.60, let's call it. All right. Because it's like $1.58 or something like that, right? So a third the width of the strikes. On the at the money, the out of the money, in the money, the out of money, 50% is what we're looking to collect. All right. Now, our market assumption, I have neutral to bullish. The neutral, excuse me, is more along the lines of the in the money option that we're buying because we've reduced theta decay. We don't have to worry about the market outpacing that theta decay, right? If theta decreases by 4 cents a day, we need our underlying to increase by that 4 cents a day to off, or actually it's probably going to have to increase by about maybe 5, 6 cents a day to offset that theta decay, right? But keep in mind, you are bullish. You really are bullish. But if you do that one that's in the money, you aren't nearly as concerned about that move because of theta. All right. So our essentials to success, picking the right environment. One of the things that I should talk about this is essentials to success is obviously having a market assumption, a correct market assumption. That is obviously the main key to success. That got brought up last week after the webinar with somebody. And yes, this is a major key to essential to success. But picking the right picking the right environment. When I talk about environment, I'm talking about volatility. And I talked about that implied volatility around that underlying. Every single underlying has its own volatility, okay? We're not talking about the VIX here. We're not talking about the VXX. We're talking about each individual underlying's implied volatility, okay? But what we need to figure out is where that particular stock's volatility is in relation to where it has been for that particular stock in the past. Because tech stocks will have higher volatility than utilities or staples for that matter. Like the Kellogg's and stuff like that. Whereas Tesla is going to have, be hovering around 50, 60 implied volatility for itself. But that doesn't tell you anything because, Kroger or Kellogg could be trading around 16. Well, does that say that Tesla has high volatility and Kroger has low volatility? Yes, but it doesn't tell us where its volatility is in relation to where it's been in the past because stocks have a tendency to stay in a range with their volatility. Yes, they can get a little bit out of whack and overextended, but what I'm talking about is, say, for instance, with Applied Material, you can see its IV right now is 31, but we could look at something like Tesla and see that Tesla probably rarely ever gets down to that low of a volatility. You can see Tesla's volatility, if it was trading around 31, it would be at its lowest level, okay? So Tesla's 30 implied volatility is really low for itself, whereas the last example we looked at, it was close to the median, right? So we have to, when we're picking the right environment, discern if this volatility is high for Tesla or if this volatility is low for Tesla. Now, looking at this chart, we can see it's high, right? But the way to determine this with math is to take a numerator and a denominator. In the numerator, we're going to take a sum and divide it by the sum in the denominator. In the numerator, we take 71, where it currently is, the current minus the low. So 71 minus 36, which gives us 30, what is that, 30, God, I can't do math today, 34. So 34. So in the numerator, we have 34. You divide that by 84 minus 36. 84 minus 36 is 48. So 30 minus 48 is somewhere upwards of 70% or so. So 74%. That was me doing the math in my head. If we did it exactly and punched in all the digits, we would come up with 74.32, right? Does that make sense for everybody? But we look at something like I said, Kellogg. Oops. Let's look at Kellogg again. And you can see 23 is its low, whereas its high is 36. So Kellogg's very high implied volatility is the lowest volatility that Tesla sees. So you understand why it's important not to just look at this number, volatility, but to look at this number in relation to where it's been in the past. Because we can see when it gets really low like this, volatility wants to increase. Well, if we're buying premium and volatility pumps up premiums, we want this to happen, okay? We don't want this to happen, so never buy premium up here when its volatility is at its highest level, because you're going to watch it. You could be directionally right. You know, look, we could do a call spread right here. Forget about the, earnings, okay? Let's just think about this in terms of volatility. The market's moving higher. We've got our directional move, but the volatility crushing coming out is hurting us. So we might not even be making money on this, because this is a heck of a lot more than 1 percentage point a day. We're looking at going from 36 down to 23. So we've got, about, what is that? 14 percentage points decreasing. That could be like 70. That could be a lot of money coming out, as this isn't increasing fast enough to offset that. Does that make sense? That's why we need to buy premium and low volatility, sell premium and high volatility, for those very reasons. If we are directionally wrong, it doesn't hurt us as bad. It helps increase your probability. So that's picking the right environment. Low implied volatility percent, which is what I have over here. You can see IV percent. If you're on TD Ameritrade, they give you it also here. Current IV percent is 34 for Kellogg. So that's in the lower range, right? Anything below 50. I like to go with these, really below 30 for stocks is the best case scenario. But if you expected volatility to increase, I wouldn't necessarily, like, say an earnings is, a month away, and if you're at a 50 IV percent, and you're like, well, Wolfman said don't do it because it's got high implied volatility, but I've got this earnings right around the corner. We would expect volatility to increase going into that binary event. A binary event is any event that affects that underlying, you guys. So a stock, dividend, earnings, and for instance, treasuries. We just had the FOMC yesterday. Volatility in and around treasuries was high. For grains, it's the WASDE report. It's when they give out the report of what all of the fields are getting bushels per acre, okay? So that's their report. That's where volatility increases. So a binary event is just an event that affects that underlying, and to go even further, if you were looking at a drug stock, when they have a trial result on that drug stock, you might see volatility spike to the highest levels you've seen in 3-4 years. So keep that in mind as well. All right. So the next one is then, so that was picking the right environment, picking the right underlying. Continue. I don't know why you're giving me that. Picking the right underlying, you guys. With this, we have to use stocks that have good option participation, okay? And to be quite honest, it's not very consistent. You would think that the ones that everybody talks about all the time should have that. Well, my rule of thumb is any stock that is under $100, for instance, Kellogg, under $100, we basically say it needs to be 10 cents wide, okay? Usually Kroger is pretty close to that. We can see one that's not, but we're going to go to the ones with the monthly options that are closest to expiration, with 20 some odd days or whatever. You might have one that has at a certain time, like 5-6 days left in the options. When it's 7 days to expiration, 10 days to expiration, then that's where I would roll out to the next one where there's like 35 or so days to expiration follow this rule. But a stock under $100, no more than 10 cents wide, and try and make sure that that's pretty consistent. Once you go further out, you can see that's not going to follow through. But know that when these options get closer to expiration, all of these people are moving out to the further ones. Now we can look at something like, anybody ever heard of this company, Toyota Motors? Anybody? Bueller? You can see that for my rule, over $100, you move it decimal 3 ticks to the left, and that's how wide our bid ask should be. So this, in a sense, is saying 12 cents wide. This does not fit that rule all the time. It is today, but sometimes it doesn't, because there's just not a whole lot of volume and open interest, as you can see by just clicking on this. 11 contracts traded today, a whopping 11 contracts. So usually this is going to have really wide bid ask. Everybody's heard of this, but a lot of people just don't trade these options. So stay away from that. Where we could go over to like Apple, everybody's heard of this stock, and you can see a little bit different, right? And it's a $200 stock, 3 ticks to the left, 22 cents is how wide these should be. And you can see these are well inside of that. You know, it's twice as expensive as Toyota, and we have like nickel wide markets because there's so many people in here on a given day watching these. So that means that people are really going through free market price discovery. All of us out here on this webinar are bidding and offering for Apple in a sense. So as soon as Marcel bids up, you know, from 470 to 471, then I come in and I offer 479. And then all of a sudden Herman comes in and goes, well, I was the 470 bid. Now he beat me on the 471. Somebody beat me on that. I'm going to go 475 bid. All right. Now I go, all right, you know, and then I hit you. So that's how all that happens, is free market price discovery. If a lot of people are in there, we're stepping over each other to get our trade. In the other one, Toyota, there might only be one guy making these markets. Okay. So he's not incentivized to make a better market. He knows he's the only player in town. You got to come to him. All right. So stay away from that scenario, because a lot of times you'll see something like with AutoZone and stuff like that is where the market, I see your question there, Marcel. I'll get it in a second. I'm sorry, I lost my chain. So Netflix is very bad. So Netflix actually, you know, it's a $300 stock, right? So 3 ticks to the left, 38 cents wide. Look at that. It fits that rule though. Yes, they are wider, but it fits my rule. So, you know, in that regard, when you're coming in here, never go, they always try and, if I were to just go in here and do this with this underlying, Thinkorswim does not care about me getting a better price. They care about getting their commission. So it's kind of like fill them and bill them. So make sure you never go right there to the market. In this case, you know, I would start out at, you know, 350. I'd just better it by, you know, 10 cents or something like that and see if somebody comes in to hit me. Also, there's spreads in there that you can't see. Sometimes there's auto leggers that'll do spreads that'll hit you. But this being the case, start out a little bit higher than mid price and then cancel replays. It doesn't cost you guys any money to put in an order that doesn't get filled. But in the case where I sell this one at $18.30, yeah, that could have cost me money. That could have cost me 10, 20 cents. I could have maybe gotten these off at $18.50. So always go through. If you don't have a ton of cancel replaces in your monitor tab where you've gone in, then you need to back up a little bit and start incrementally going a little bit higher than where you would expect to originally get filled. And then I'm not saying wait 15 minutes. If you want the trade, it's kind of like we looked at it on the floor. Do you want the penny or do you want the trade? So you have to make that decision as well. But if I want the trade, then I'm put this order in at say 350, you know, maybe 355, confirm, send. And then by the time I go into the monitor tab, cancel, replace, change my price, enter to 50, that's enough time. All right. for all of these algos to figure out if they can leg a spread or if there's an opportunity. So just hit it, confirm, send, go over there. By the time you get over there, click it, change the price, confirm and send. And 2 or 3 times is probably, you know, a good amount of times to get filled. It may only take 1 time. And believe me, I've been in situations where I put it in just a couple of nickels outside the offer on something like this, and I've gotten hit because there are spreads in there that are maybe 18.50 bid to sell the 17.15s or something, okay? Because there's a spread that we don't see. Does that make sense? Okay, good. So that's picking the right underlying. Tight bid ask. Now we kind of went over this, picking the right duration. So you can just go through these steps. Do I have a market assumption? Yes. That's key to success. Is it the right environment? Low volatility. The lowest volatility is better. You know, the lower the volatility, I should say, the better. Picking the right underlying. Tight bid ask. Picking the right duration. Well, this is what happens when the thief in the night comes and steals your premium. He starts getting more aggressive the closer to expiration. He knows he doesn't have much more opportunity to steal from you. So he starts picking up that theta decay. So in that regard, do we want to be in here when we're buying premium and we're watching that theta tick away? No, we kind of want to be out here where we see that slower theta decay. Also, it gives us more time to be right. You know, long call spreads, long put spreads, you need to have that market move in order to be right, which lowers your probabilities of success, right? Because the market can go up and go down at any given time. We need this to move up, and we're fighting that battle, but we're also fighting the battle of theta decay. So we want to get a little bit further out in time, which is out here. We want to get out here in this green area. Remember I was talking earlier on, I like to get outside of the 45 days and somewhere in that 65 days. We don't really have that opportunity right now. We're kind of like either, which is fine, we're either right here or we're kind of like out here, all right? Now, I'm going to lean a little towards this way every time, okay? I'm going to check this one, but I'm going to lean towards this, right? For one, I have less theta decay. 2, I have, you know, what, 25 days, 28 days longer to be right. You know, I almost have an extra full month to be right. That's worth paying a couple extra pennies for me. And sometimes you will even see a situation where it might be less money to go, cost you less money to go further out in time. It's not always, but you can find those situations arising. And that's the kind of opportunity we're looking for as well. All right, picking the right strikes. I went over this. 1 standard deviation away on either direction. So what we were looking at in this, let's go to applied materials, because Netflix, I think, has too high volatility, right? Applied material. Now, this is a crazy one. Like applied material, when I was going through these scenarios, look how tight these markets are. Like, does anybody really know or hear about applied material on a daily basis? I mean, it's really tight for even an underlying that's trading 40. We could look at Starbucks, and Starbucks probably isn't any tighter. It's even just a little bit wider, you can see. So applied material has really good markets, all right? And you can see they have a lot of open interest and a lot of volume on any given day compared to especially like Toyota. All right, so we don't care about that anymore. What we want to look for is the 84 delta. We have one here. Like I said, the 84 delta is 1 standard deviation away. You're going to have to trust me on this because a 16% probability is 1 standard deviation, okay? And 1 standard deviation to the upside is a 16 delta. 1 standard deviation on the calls that are in the money, you basically subtract, you know, a 16% probability away from 100 and you get 84. That's where that 1 standard deviation comes in. It's 84 or 16. So we're going to look to buy further out in time because I don't want to go that close. Like we got theta decay. I don't have much time to be right. So let's go out and check. We don't have D's, but let's just check the Nove anyway, because I might go out to the Jan since we don't have D's. All right, so we don't have the 34 strike. So let's look at this 35 or let's look at the 35 strike because that's about as close to it. We could look at it in the money further as well, but 35 strike, and then I'm just going to go start out with $10 wide to see if it works. So I would need to collect. I want to collect about 50, pay 50% the width of the strikes. That's a little bit wide. So let's try and go a little bit closer, and we buy. I'm going to go back to the 35s. Another thing to do to make sure you're doing this right, try and make sure you look across. This is another little hack I have, that when you're looking at options, it's not perfect, but when you're trying to figure out the intrinsic and extrinsic value, remember we said all options out of the money are all extrinsic value, right? Stocks that are in the money have intrinsic value. Intrinsic value means what it's worth. So the 35 strike that's in the money is worth really $3.35, because if I'm buying this strike, right, 35 strike to 38, the value of that should be about 38.35. All right. So a trader hack we have is take this and look straight across at the counter opposing puts. That's a ballpark figure, very close. It might be off a nickel or a dime. And, of course, when you're talking Netflix and stuff like that, or Google, it's a little bit wider, but you can just quickly, I'm all about like trying to figure things out quickly, right? We only have a certain amount of time in the day. I don't want to sit there and go, okay, I got to do all the math. 35 strike is $3.85. $3.85 is what this is worth. So what's the extrinsic value? $3.85 minus $4.15. Now you're coming up with 65 cents, 70 cents, right? 65 cents, 70 cents. Yes, I'm off a little bit, but when we're doing this, I don't care about that extra nickel. I'm just looking over here, times money, say 60 some cents. So the one I want to sell should probably be close to 60 some odd cents as well, right? To try and pay off that extrinsic value. We don't have to worry about theta anymore, right? Because if I paid off the extrinsic value, the value of this is very close to it. So now we look at, we're buying this stock, right, at the 35 delta, or the 35 strike. We add in the debit we paid, so 35 plus $3.22 gives me $38.22, right? That's what we're paying for this underlying with the embedded put. I mean, where can you beat that? We can't buy right now 38.22. We're buying it 10 cents below the market. Okay, so that's the beauty in options as well, is we're actually able to buy this below the market by doing this spread. All right, and now we have to check. We have a $7 wide, and we are paying less than 50% the width of the strikes. That's good, right? That works for us. Now let's just see what the Jan has to offer. Let's try and do those same strikes. So I'm going to go to the 35.42. So let's do this same ones, 35.42, just to compare apples to apples. We can look at this. 35 strike has around $1.20 something in extrinsic value that I got to pay for by selling these, and it was a 30.42. So, and we're paying $3.44. So it's almost about the same thing, right? So what would you rather do, the Nove or the Jan? Same strikes, but I've got an extra 60 days to be right or wrong, however you want to look at it. But I have 60 more days to be right. I'm going to go for this one. I paid the same amount of money. It's not costing me anymore. So why not go further out, even if it's Jan? Yes, even out to the Jan. I mean, you could probably even go out to the April. I don't like holding on to it that long. It makes it a couple other things a little bit more difficult, but somewhere in there, look for the ones that are outside of 45 days And even further, I like to go like that 65 days, but I don't have the Ds, but that Jan sure works out, right? So if I were bullish, Applied Material would fit those rules. Now, the other one was, right? Now, let's just say you don't want to pay $3. You're like, I like to pay a little bit less. For this one, we're going to look at the ones that are at the money, just slightly out of the money. It's 38 something. It's kind of a pick 'em right here. But let's just look at it. Let's buy this one, 39 strike. Let's go $3 higher, so the 42s. Sell that one. And $3 wide. What's my rule on this one on the out of the monies? This one was 50 cents with the 84 delta. This one is a third the width. So we got $3 wide. You know, we're only paying $1. That's really close for government work. So that fits that rule as well. So you have two options. If you don't want to do the one that's in the money, you want to pay a little bit less, you can go with this one. You need to be a little bit more bullish with this one though, right? Because for me to make it all the way to that 42, we're not going to start seeing an increase in our premiums very fast, because this is only going to increase this premium by 47 cents. Whereas when we're down here in that 80 delta right here, remember, for every dollar move now, this premium is going to increase by 79 cents for that same dollar. So we are paying a little bit more, but we are being rewarded for a correct directional move. We are penalized a little bit more maybe on an incorrect directional move though as well. You can look at it. So this one has a lower probability of success on the out of the money one than the one that's in the money, only because when you're in the money, I have an 84% probability of being right, you know. So and because I paid for all that extrinsic value, I will get the value back if nothing else changes. So we want 50% the width of the strikes on the 84 delta to the 16 delta, and a third if you're doing the at the money or just out of the money on those. All right. Did I answer you guys' questions on that? I'll go over another one. So we can look at this one. I'm not sure why those changed a little bit. I think these in the money's got a little wider. All right. So let's look at another example real quick of some that have a little bit of love. Was another one that I looked at. And you guys throw out a couple of examples. Forgot to mention that in the questions window there. If you guys want me to look at a couple of stocks that you guys look at daily, then let's take a look at those as well. You can throw them in there and we'll go over it as we go here. So let's look at Southwest Airlines, and because they have the D's here. So let's look at the D's. We're going to kind of go to that 84 delta. That's where we start. Well, it's not an 84 delta. You're not always going to get an exact 84 delta. Just kind of do the pick 'em between which one. You might have to check both of them to see if it works. This one, we got the 55s, and then I'm going to go up to probably the 18 delta, because if I look at this one across the way, right, I need to at least get 60 cents to pay off the extrinsic value, right? Options out of the money are all extrinsic. Options in the money have intrinsic and extrinsic value. You can figure it out. 55 to 62 is 12, or 55 to 62 is $7.71. You can subtract this out of there, and it's going to be a little light on this one. That's what I was talking about. So it's going to be a little light on that one. When you add in the $8, it's going to be, you're paying slightly higher than where the underlying is trading here in that example probably. But let's just check it out. So 60 cents is where I need to be. Let's sell that one. So you add the $8 into the 55, we're trading at 63. So we're buying these at 63, right? So slightly higher than where it's just was. It's actually middle of the market, really, because you see the 63 offered, 63.25. All right. So the next thing to figure out is we have $15 wide. It's 50% of $15 wide. It's $7.50. So it doesn't fit that rule. It's pretty close. Now I talked to you guys about like green light. If it's below 50% the width of the strike, that's a green light all day long, right? We get to 50% of the width, that's green light. We start getting over that, you start getting yellow lighted, right? It's like, okay, this doesn't fit the rules, but I'm really bullish in this. It's really close. I just have to be cautious, more cautious about this. So in this regard, this type of spread, then I would have to be a little bit more cautious on my my strategy. All right. The other thing we can do is then look at the one that's just at the money, go $5 wide, and you can see that fits that rule because a third the width of the strikes on a $5 wide is like $1.60 something. So we're inside of that. We're doing the at the monies, $5 wide, and we're fitting my rule. All right. That makes sense? All right. So that was picking the right strikes. Now we have to know our exit strategy. What do we do if we want to get out of this thing? How do we get out of it? All right. If we are doing the one that is the long call for that collar, right? When we see our premiums increase by a third, then that's where we're getting out. Okay. When we're buying the out of the money one, the one that was at the money and out of the money, that one we want a 50% increase. Okay. So it's kind of flipped. If you're doing the 84 delta, we need 50% collection, and then we're looking for a third increase. So, you know, if we pay $5 wide on a $10 wide, when it increases to $7.50, that's where we're getting out of that 84 delta in the money one. All right. So it's flipped. 50%, we got to collect 50%. A third increase, we're out of that one. The at the money one, where we're doing the at the money, we collect a third, but we look for an increase of 50%. All right. Does that make sense? Or a double on that. So it goes from 33 cents, actually it's more of almost 100% increase on it. So 30% to, or 30 cents on $3 wide, or 30, if we collect or paid 33 cents on a $3, sorry, I'm confusing myself today really bad. On a dollar wide, we expect to pay 33 cents. When that goes to 66 cents, that's when we're looking to get out of that one. All right. Does that make sense? So that's our exit strategy. And a lot of you guys will ask, what do you do when it goes against us? If it's the spread and I'm paying a debit for it, you guys, I ride these into the sunset and play the probabilities. All right. So I'm playing the probabilities on a debit spread. I know what my risk is. I'm not going to worry about it. If you guys do it as a chart setup, I have no problem with that. I have friends that do it on a time delay. But if you did this as a chart setup, for instance, and you were like, okay, I'm going to buy this because I'm bullish. Southwest Airlines, everything else looks pretty good. Maybe if it broke, you know, your support level, if you have Fibonacci up, I'm going to do this real dirty. But if you said I had a Fibonacci on here and it broke that Fibonacci support level, I'm out. Okay. I have no problem with that. In the same for if it reached this target, then I'm out on the long side, right? If I'm bullish and it reaches my target, that's where I'm out. You know, another thing to think about it is if we're doing those spreads, as soon as our short strike gets hit, we're out. Okay. And that answers Marcel's question, I think earlier on, where you got to worry about assignment on that. Well, Marcel, usually with my rules, by the time it gets up there and gets kissed on that short strike, that's usually reaching the profit potential that I've laid out there for you. Okay. So as soon as those short strikes get hit, you know, you're not going to get the full width of that spread value until the very last day. And I don't like to go to the very last day. I like to get out of these well in advance of those very last days. All right. I want to get in and out of these quickly, increase my probabilities of success. I don't want the market to turn around and bite me. All right. All right. So max profit on this is the width of the spread, the short call spread minus the long call spread minus the premium paid, right? On that in the money ones, we're looking to collect 50% the width of the strikes, right? So we have a $10 wide spread collecting $5. Our max profit would be $5. On the flip side, max loss is always that premium you paid. All right. So in this example, the $5 would be the premium we paid. And in the example of the at the monies, then our width of our strikes are on a dollar wide, we paid 33 cents. Our max profit would be 66 cents. On this one, our max loss would be the 33 cents. Okay. And the break even is that long call strike plus the premium paid. You got to keep that in mind. Remember, we were talking about that on those in the money ones where we were saying if we just took, let's go back to applied material because I think that one had the best examples. So on this one, we're looking at the 33s. So the 33, and I think I went to the 43, wasn't that right? Because we can just look across 70 cents. I actually can go a little further out and go to the 44. So 33 to 44, and I'm $11 wide. I'm paying less than 50% the width of the strikes, right? It's $11 wide, so $5.50 is where I need to be or less, and we meet that. So that's good, that far out especially. And so our break even, when we were talking about, we're buying this strike that's in here in the money, 33, right? So our 33 call plus the premium is our break even. And that's what I was talking about. Now we're at $38.14. That's where I was saying $38.14. We're buying this below the market. So our break even is below the market. So if you can do that where you're getting it cheaper, jump on it, right? When do you ever get to buy below the market? Option is the answer. Okay, so 50%, and when we would get out of this one at $7.60 or something, right? On this one, we'd look at the 39s and say, let's go $4 wide. Let's just see what $4 wide does. It does nothing when it doesn't work. 39 plus the, what did I say, 43s? 43s, so $1.40 on a $4 wide. $4 wide should be about $1.25, right? So actually, should be about what should that be? I can't do math in my head today. I've got too many things going on, I guess. So so $4 times 0.33 equals $1.32. So that's actually a little bit more than a third the width of the strike. Let's just do this one and do $3 wide and see what we come up with there. $3 wide, we should be closer to $1. And believe me, when I was doing this morning or betting these, that was working out. What did I have it at for the out of the monies? Yeah, well, actually it was right around here. So that would be like closer to a yellowish light, all right? Right? Because we're paying, actually, no, that's good. We're paying less than a third the width of the strikes. So we're paying $1.15, $1.32 would be the max we'd be willing to pay on that. Does that make sense? Third the width of $4 wide would be, the $3 should be about a $60 something. Oh, God. Times 0.33. Everything's going well today for me. How about you guys? Times 0.33 equals 99 cents. So $3 wide, 99 cents. I should have been able to do that in my head. So that's paying a little bit more than what we should be wanting to. So it doesn't always work. You know, if the one doesn't, the in the money, then check the out of the money. If the out of the money isn't working, check the in the money one, okay? Because one of those will generally work, okay? If you have the low implied volatility like I'm talking about. When you start getting high implied volatility and stuff like that, that starts getting a little bit of a different story. All right, you guys clear on that? Somebody was asking about put spreads. I'm going to be doing that next week, I think. Or I am going to be. I don't have to think about it. I am doing it next week. So, and that's about it, you guys. Other than, you guys need to take advantage of this. 2 months for the price of 1. Now, I talked about daily market commentaries. I do webinars every Thursday, you guys. But every single day of the week, I do like a 15-minute video on the daily market commentary where I cover economic, geopolitical stuff, how the data is going to affect the overall economy and or what we should be looking at for market assumptions and stuff like that. I talk about all of that stuff. I even go into more detail about support resistance levels with the Fibonacci and the market profile, which is that blue thing off to the side of my charts, and how to trade in and around that. So with this premium membership offer, which is in the chat window, or it will be in the chat window. Let me send it out there. It's in the chat window right now. I'll just double check I did that right. Yeah. Or if you're watching this on tape delay, you'll just have to pause and punch this into your URL. But with this, you guys, 2 months for the price of 1, great deal. As a matter of fact, I was just doing the math in my head not too long ago, a couple of days ago. We're paying a tutor in Spanish almost as much to tutor my kid. And we're talking real money here for this. So basically, you're getting your own private tutor that is at your beck and call in a sense, because with this premium membership offer, you get the daily market commentary videos where I talk about everything I do, all the trades I do, whether they're winners, losers, how I'm managing those losers, which is very important. Like the winners, we don't have to talk about, right? Okay, yeah, we got it right. The losers, we need to spend about 85% of our time on, you guys. So I talk about how to manage those losers to turn those into winners, if we can do it. And also you get online trading web videos. There's over 100 of them now, but I have all of my videos on there from the past that I've gone over all of these. You can just go through and easily check it off. Also, the other thing you get is like little short videos on specific strategies that just go over the basic rules. It's not an hour long. It's like, 5-10 minutes long just to get you those rules back in your head. The most important thing I think you get, though, is unlimited access to me, you guys. So if you have a question on anything around what we're doing here, ask me. Send me an email. I will respond to you today, okay? I'm going to get back to you right away because I know how it feels when you are stressed out and need an answer. So I'm going to reach out to you in an email. I'll give you an answer. And if I can't answer that question in an email, I'm going to try and give you a phone call and we'll talk through it. All right. So take advantage of this. It's a great offer for less than what you would pay for a Spanish tutor. And you can reach out to me with any questions at 310-598-6677 or email us at trading@protraderstrategies.com. Yes, Joy, that's in the chat window, that link. Or you can punch it in, especially if you're watching this on tape delay. Right here is the same offer. Want to thank you guys all for participating in this. Later webinars, I'm going to be drilling down on different option components, how I trade, trades I find, and when and where I find them appropriate. Also, you can, again, reach out to us at 310-598-6677 or email me at trading@protraderstrategies.com. All right? Guys, seriously, take advantage of this because one of the few things we can do is educate ourselves to increase our chances of success. I have this set up to try and make it as easy as possible for you. Obviously, you guys are doing the first step by taking this webinar, but move on to the next step. Get in there with me. We, in these daily market commentaries, go into directional assumptions, support, resistance, all of that stuff. So I think that those are about as important as anything else. So just want to thank you guys all. And if you can't take that, take it easy. Take care, guys.